5, 4, 3, 2, 1. You will hear a prompt saying
G'day everyone and welcome back to this ShareCafe Hidden Gems webinar. Now, really the only observation this week is it looks like the market's looking for a new theme to play. Uranium seems to be in focus following its 40% rise over the last month, so it'll be interesting to hear from some companies online to talk about that today. Lithium continues to set new records, so money kind of remains there. And iron ore, we've seen some profit taking, well, lots of profit taking. Buy now, pay later seems to be a theme that kind of came and went with increased competition. Gold is always in play one way or the other, but perhaps the next theme is gas, which has gone through the roof in recent times. But as the gas price surges, oil and gas stocks continue to sell off, which is unusual, but it seems to be that the smartest guys in the room have run away from this exposure due to stricter ESG mandates. So it'll be interesting to see how this theme plays out without the support of ESG sensitive fund managers and institutions, because there's obviously fundamental value here across the board as commodity prices like gas surge. But ideological and political pressure forces prices in the opposite direction. So it's going to be really interesting to see how this theme plays out given all those unusual circumstances. Now, don't forget to ask questions, type them in the Q&A box provided. Everything is being recorded, so you'll be able to find the individual recordings on our YouTube channel this weekend. Okay, so let's make a start. First up, we have Prime Financial Group, ASX code PFG, market cap of around $26 million, a one-year return of up 79%. The company provides accounting and business advisory, wealth management and capital advisory services. We have with us the CEO, Simon Matter. Simon, over to you, mate.
Fantastic. Thanks very much, Tim, and thanks for the opportunity to present and welcome. Right, we might jump straight into it if we can. So the important notice and disclaimer, please read that at your leisure. So where we'll kick off today is just some of the key financial highlights in terms of FY21. We had an improvement in our underlying EBITDA, up 22% for the year, which we're very happy and pleased with. We've been able to expand the margins within our business. So our business is now achieving a 30% margin, up from about 19% 2 years ago. We've had a substantial improvement in our net operating cash flow, and that's allowed us to continue to increase our dividends for our shareholders. In fact, for the full year, FY21, our dividend was up 56% and the final dividend was up 60%. Importantly, we've also forecast that for the FY22 year, we expect dividends to be up a further 40%. So we have the right momentum in terms of the development of the profits within our business, the cash flow, and therefore the dividends for shareholders. So revenue was up around about 4% and expenses were down 3%. So we have those nice positive jaws in terms of the things that are driving that margin improvement. And we've also been able to reduce our debt profile. So our debt is now 1 times underlying EBITDA. So overall, the business is in a really strong position, and we're very optimistic about what FY22 will hold for us. But let's just dive into a little bit of detail about what Prime is all about. So if we could go to the next slide, please. So for those of you that haven't actually heard of Prime, and Tim did a good job of introducing it, we're a professional services firm. We operate across Melbourne, Sydney and Brisbane, which are our core hubs where our ideal clients are and also where the talent resides that we want to work with. We have around about, now it's up to 106 team members in those core locations, but we're also building out our back office services through our Manila operations as well. But our core proposition in terms of what Prime is trying to do differently within the professional services space comes down to ultimately offering multiple services to our clients through the one experience. That's our one connected mandate, if you like. So we're in a nice position. We've got a growing market share and we see great opportunities for the future. We might just flip on to the next slide. So in terms of how our revenue is broken up across those four key service lines, which are two segments, we have the accounting and business advisory, including capital segment, which makes up 59% of our overall revenue of $22.3 million. We have 41% is wealth management and SMSF. We currently manage around about $1.1 billion for clients. And the typical client within the wealth division is around about $1 to $3 million of funds under management. Importantly, if we look at that top left-hand corner of this slide, 78% of our revenue is driven off the back of our own brand with our own interactions with our own customers. And 22% comes through joint venture arrangements we have with other accounting firms to help them deliver some of the services that we offer that they cannot offer themselves. So we have some distribution by virtue of that. That gives us a little bit of growth opportunity there. But overwhelming, you'll see us continue to drive more revenue off our own interactions and developing all four service lines. Please go to the next slide. So some of the peer comparisons that we have, and Tim has highlighted, we've got about a $28 million market cap at the moment. The companies that we compare ourselves with are on the sort of the middle part of that slide there, where we have Kelly Partners Group and also Count Plus. They're most similar to what we do, but we fit within that overall segment there that has been listed. Our reported earnings per share is 1.69 cents per share, and we're trading at around about 8 times at the moment, which is approximately half what some of our peers are trading at and probably a third of some of the others. So we think there is an opportunity for some upside within the business and the share price. We have a good, strong dividend yield at around about 5% at the moment as well. So moving on to the next slide, please. So this is some of the stuff that I've already touched on in terms of the shape of our revenue. So $22.3 million, up 4% in FY21. Underlying EBITDA of $6.8 million. NPAT of $3.1 million. EPS I've covered off. A final dividend of 0.4 cents per share. That's paid in the first week of October. And an overall dividend of 0.7, moving to 1 cent per share in FY22. On to the next slide, please. So just to look at that shape of that revenue in a little bit more detail between FY20 and FY21. So accounting, business advisory and capital has been growing at around about 10%. We see that there is a great opportunity to continue to build out our capital or corporate advisory service, which is typically for businesses that have a value between, say, $20 and $120 million. We think that division can grow from around about $3 million at the moment up to sort of $5, $6, $7 million plus over the coming years. And also when we look at the second segment there, the wealth management and SMSF space, for the first time in 3 years, we can really see an opportunity to start to grow, particularly the wealth management division, into the double-digit revenue side of things. We see that happening through a greater focus on wholesale clients and also how we can internally generate opportunities from our existing accounting client base into wealth management and SMSF. So we have a really unique opportunity to not only drive growth in revenue through cross-referral, which is a core part of our strategy, but also each division being able to get their own new clients as well. So we see that we've got a couple of different avenues there to continue to grow our business. Our goal on a 3 to 5 year basis is to push our revenue through to around about $40 million from the current $23 million. Here you see the shape of the revenue growth over the last 4 or 5 years. So between 4 and 10%. we are optimistic about FY22 being at the higher end of that range that we've had in there previously, and we'd like to see that come in at double digits. So moving on to the next slide, if we can. So not only are we looking at the organic growth from new clients and new services for existing clients, but we're also starting to tuck in some of the inorganic growth opportunities. So actually bulking up the teams that we have, those 4 core teams. And recently we undertook a transaction with a business called Alpen, where 2 or 3 of their team members joined us as part of bringing their revenue, their contact, their network base in to our audience, and also offering some of the skill sets that they have to our existing client base. So that's around about $1 million of revenue that they've been able to achieve in the previous 2 years, so each year for the previous 2 years. And that fits in nicely as part of our growth towards that $40 million revenue target. On to the next slide, if we can, please. So we have been in a strong position in terms of managing our cost base. You'll see there between FY19 and FY21, we've been able to reduce expenses by 6% in FY20 and then a further 3% in FY21. So we have a strong control over our cost base. We've done that by virtue of centralising a lot of the services for finance, HR, IT, marketing, etc. We're also getting a lot of leverage off our IT system, which is allowing us to identify where opportunities are for improvement, not just at the revenue level, but also around how we manage costs as well. We also have the offshore team that is building. That offshore team was probably only around about sort of 5% of our overall team member numbers, say 2 years ago. That's now up to around about 21% of our team. So in terms of the underlying EBITDA, we had a 22% improvement, as I mentioned before, in FY21 and a 7% improvement in the previous year. We've now had 3 strong years of improvement on that front. Moving into the next slide, please. So I've touched on the margin improvement, but from 19% to 30%, which we feel is a very sustainable margin for a business like ours, and probably top quartile, that's what we will continue to target for the following years as we grow our revenue base. Our operating cash flow, as I said earlier, is very strong in FY21, up to 5.5 million from 1.6 million in FY19. That is providing us with opportunity to continue to improve dividends and reduce debt as well. On to the next slide, please. So dividends, I've mentioned a number of times, it's a key theme. At the moment, we're currently paying out about 41% of our reported NPAT for members, shareholders. We do have a DRP as well, but we are targeting to be able to pay out 40 to 60%. So at the moment, we're at that bottom end of the range, and we see that can improve. And so what you see there in the bottom right-hand side of the slide is what we are forecasting the dividend to increase in FY22. Next slide, please. So I mentioned before how we've been able to manage our cost base very strongly over the last couple of years. I think it's important to note that we've been able to do that in obviously a difficult environment, but also without hurting the service that we deliver to our clients. So one of the things that we measure ourselves as part of our balanced scorecards for all team members is the feedback that we're obviously getting from our clients. That's a key part of having them be advocates for the future. And one of the things that is used quite commonly is a net promoter score. So we actually surveyed our clients over the last 18 months, and we've seen substantial improvements in those scores. We've actually seen them move from 39 to 54 within the accounting and business advisory division, and from 29 to 41. So we have a very strong focus on what we do for our customers and for our clients. And over that difficult period, we've still been able to improve how they have been rating us. And just to put that in perspective, a net promoter score can be as low as -100 to as high as +100. And at the moment, the range that we sit in, as you see in the bottom right-hand corner, is considered great. So anything above 30 is great, which means that we're in a nice position. Clients are valuing what we do. And obviously, we haven't been able to service clients in exactly the same way, be it face-to-face, as we would have previously. Moving on to the next slide, if we can, please. This is the final slide that I'll cover off with a bit of detail. So in terms of our outlook, we expect to keep the same momentum that we currently have. We want to increase our earnings and our revenue into FY22. We'll keep looking for those inorganic growth opportunities, and we have a few of those that we are in continued discussions with now. Dividends are a theme, clearly that we see those increasing. Debt coming down anywhere between 0.5 to 1 times. Capital management initiatives we have raised. We raised this at our FY21 presentation. We put a buyback in place in the middle of this week. That gives you an indicator as to how we see value from our current share price. We'll continue to align shareholders in the team. 42% of our company is owned by key management staff. Our staff are our biggest asset. We want them to continue to be aligned with shareholders. We're also reviewing our existing board structure. We want to bring on another independent director to that structure, and we'll keep prioritising our people, obviously client service and compliance as well. So business is in good shape, Tim, and I'm very pleased to take any questions that we might have just around where the business is at and where we're going.
Thanks, Simon. It's a very attractive, fully franked dividend deal. Start with that. Now, this whole industry has grown through acquisitions, and you spoke about growing your wealth management division, if you like. Are acquisitions on the table?
Yeah, look, I think those inorganic opportunities, I think it comes down to the culture and the selection of the people that are attached to that. So we've got a great team at the moment. We've been able to drive this philosophy about delivering more services and value to our clients. And I think if we can find more people like we just recently did that have that same philosophy, that don't just look at their own particular skill set, but the totality of what we can do for clients, then absolutely we will look at that. But it won't be done on the basis of putting the balance sheet at risk at all. So we've been conscious of reducing debt, but increasing alignment with shareholders and the key management and staff within the business. So we'll look at them, but we'll be pragmatic and careful.
And the core of the employees you have here, are they financial advisors or are they accountants?
Yeah, so it's probably an interesting split. We've got around about 40 accountants, about 106 staff. We've got around about 30 that fit within the financial advisory team. There's about 10 in the corporate advisory. The SMSF team has around about 10, and the rest are head office team members, all those placed overseas.
And you were talking about your kind of core customer being $1 to $3 million under management. Is there a way the industry can service the smaller investors, if you like?
Yeah, it's a tough question to answer because the cost of compliance within wealth management, which makes up around about 40% of what we do, has clearly gone up. And it's a different environment. So I think, look, ideally you want to be able to deliver services to anyone that has the capacity to be able to pay for them. But what you're finding is that there are minimum costs now coming into the whole advice space. In our case, it's a minimum cost of $5,000 for any new client. And so it's not necessarily just driven by the size of the funds. And we are also pushing up into a higher bracket of high net worth clients. Recently, we've had quite a few clients that have joined us between $5 and $20 million of assets under management or funds under management. But our typical client, if you like, is a business or a business owner or a family group as well. So our typical client on the accounting front is probably paying a fee between, say, $10,000 to $20,000 a year. And the wealth is probably between $5,000 and $10,000 a year. And importantly, about 80% of our revenue is recurring in nature.
And just time for two more quick ones, if you like. While the cash position is excellent, will the DRP continue after the final dividend?
Yeah, so I think it's important. We've had shareholders have participated in the DRP for the last 2 or 3 years. We don't see any reason to reduce it or get rid of it. We had a discount previously on it. There's no longer a discount on it. But we think it's important to provide people that opportunity to continue to reinvest.
And finally, liquidity is an issue in your share price. So how can you manage that better, if you like?
Yeah, look, that's not an easy one to answer. Obviously, there's a finite number of shares on issue at the moment, and interesting, liquidity has started to improve a little bit over the last month or so as we've been out showcasing our results. But look, it's not an easy one to answer. There is obviously key alignment with management in there, and that's not probably a part of the pie that will move on. So there is a small amount of shares available, but look, I think the key thing is to just get on the bid and see how you go.
Yeah, fair enough. Okay, Simon, that's all we have time for. As I said, a very attractive dividend yield story as well. So good luck out there, and love to get you back on before the end of the year.
Thanks for your time, Tim. Cheers.
Thank you. Next up, we have Wits Mining, ASX code WW not WW1. Market cap of around 67 million, 1 year return of up 25%. The company aims to explore and evaluate and extract gold and uranium from project areas located in South Africa. We have with us the Managing Director, Jack van Heerden. Jack, over to you. Thank you.
Hi, Tim. Thanks for the opportunity to speak here today. It's going to be, I'd like to introduce you to Wits, which is a small cap company on the ASX. Next one, please. Please read the disclaimer and then, familiarize yourself with that, please. We can go to the next one. All right. Just, Wits is like I mentioned, it's a small cap mining company on the ASX. We sit with two strong projects that we believe. One is based in South Africa, and then the other one is in WA. In the South African project, we believe that we've got a very strong resource here. We've got a 3.5 million ounce JORC compliant resource, of which I think is significant is that 63% of that sits in a measured and indicated category. So, it gives us high confidence of planning our mining forward. We embarked on a scoping study a couple of years ago, and from that we then derived 5 mining areas, and we decided to put them into stages into operation. So we recently announced our stage 1 DFS result, and that came out very strongly. I'll get into that in a bit more detail. But on top of the DFS, we also have the opportunity for early mining initiative, what we call. And from that, we hope to produce about 5,000 to 8,000 tons a month, starting early next year. Our feasibility have indicated that, we can start off with a relatively low capex and also a very competitive all-in sustaining cost. And ultimately, we want to grow this ore body in South Africa up to about 90,000, between 80 and 90,000 ounces per annum. And then we've got about a life of mine in excess of about 20 years. So we've got a strong project here in South Africa. Also in WA, we've got a 100% owned project there. Last year, we spent time and money on aerial surveys. We've just completed a ground survey, and we've got a ground truthing team on site at the moment. And the whole objective of that plan is to compile a drill-ready program for next year. And then hopefully when the drilling season starts next year, we can then enter the area and start drilling. Next slide, please. This is just a quick overview of our current company structure. We recently raised some money, so we're in a fairly strong cash position. This last point there that I just need to point out is our BE ownership here in South Africa. That's a requirement, and we are fully compliant here in South Africa to continue with this mining operation. And I just want to point you towards our current market cap and our current enterprise value per ounce, which I think is at the moment we've quite undervalued. And as we then progress the project, we hope that our valuation will increase over time. Next one. Right. This is our company structure. I just want to point out that our chairman, Michael Quinnett, has been on the board here for about 13 years. We've got a prominent mineral rights lawyer here in South Africa, Hume Scholes, that's been assisting us. And then also we've got that lady, Tozama, who's been instrumental in obtaining our regulatory approvals for us. So if you look at this team here, we've got a very strong team, experienced in Australia and also experienced in South Africa that can push these projects going forward. Next one, please. A quick overview of where the project in South Africa is located. It's located about 15 kilometers to the west of the Joburg CBD. It's in a world-renowned mining area that area, the West Wits Basin or the West Witwatersrand Basin, has been delivering ore for the last 100 years. You can see there, about 247 million ounces have been taken out of that area already. And if you look to the right-hand side on the screen there in the bottom, you can see where the West Wits project area is located. I need to point out that that's also, it's a historical mined out area. And, so we are very familiar with the geological conditions as well as the other technical conditions there. There's a couple of old shafts in that area, and our plan is to reopen and rehabilitate some of those shafts and then continue on with the mining. That specific mine that we want to focus on initially was closed in 2000, and we've had initial inspections there in November this year, where the guys have gone in. They were able to walk around there freely, so we've got good geological conditions there to continue mining going forward. Next one, please. As I mentioned there before, we've got a 3.5 million ounce resource, and you can see there, of which 2.5 million ounces sits in the measured and indicated categories. And also, as part of our scoping study that I spoke about earlier, we were able to identify 5 key mining areas. Now you can see them on the screen on the right-hand side, where we've got the Kala Shallows, Kala Deeps, the Bird Reef East, the Main Reef, and then the Bird Reef Central. These mining targets sit on different reef types, and we decided from our scoping study to start focusing on the Kala Shallows first, and then roll over into the Main Reef, then Bird Reef, and then going to Kala Deeps, and then leaving the Bird Reef Central for last. If you go to the next one, please. So from our scoping study, we were able to derive an overall production profile, where you can see there on the screen that we comfortably run between 80 and 90,000 ounces for about 17 years. And, that's our overall structure. You can see the 5 stages of mining on that graph. Now, what we've done is we've taken the first one, the Kimberley Shallows one, or the Kala Shallows project, which is the sort of the bright blue one there on the left-hand side, and we've turned that into a DFS. Now, if you go to the right-hand side, you can see just that one project will deliver about 50 to 60,000 or 55,000 ounces per annum for about 10, 15 years, So it's just that one project is quite a significant project. And then our plan is now to start adding the other stages of mining. We're finishing off some geological work now, and then we will roll over into feasibility studies for the next one is the Main Reef, and then the Bird Reef, and then the Kala Deeps. So those studies will kick off later in the year once we've completed some further geological work. So there's a significant ore body here that we're now putting into operation. We've just started with the bush clearing. So, we hope to gain a couple of months on the development of this mine. Next one, please. The feasibility study that we recently announced, we were able to declare reserves of about 280,000 ounces, which is quite exciting for us. So that underpins our initial mine plan. As I mentioned earlier, we've got a 17-year life of mine just from that stage 1. We've got a very competitive all-in sustaining cost of about $11.45 US dollars per ounce. And the reason why we mention the steady state production is that we've got such a long life of mine that it's important to note that once we are through the build-up process, we would be running at about 10.27 US dollars per ounce, which makes it very competitive here in South Africa. And if you put everything together, you end up with a pre-tax NPV of about 150 million US and an IRR of 35%. So those are exciting numbers, and it's important to understand that, that's just stage 1 of 5. As I mentioned there, the the development of the other stages we will then roll out, as I mentioned earlier. The picture on the right-hand side just indicates that we would start with the blue and yellow mining areas. The blue is actually what we call the K9A reef, and then the yellow one is the K9B reef, and they sit on top of each other like this. They are probably about, they dip at an angle of about, 45 to 50 degrees, and, they're about 5 to 7 meters apart. Thank you very much. Next one. All right, the other exciting project that we've got, as I mentioned, there is our Mount Cecilia project in the Patterson province in Western Australia, where we've just completed our aerial survey. And from our aerial survey, we were able to identify 8 targets, and you can see where it's located. It's right in the middle of where everybody is exploring. So we see that as a very highly prospective opportunity for us, which we want to just push up the value curve. Next one, please. Sorry, Tim, I know it's, there we go. I just want to quickly take you through the 8 targets that we've identified with the 3 or the 4 targets that we've now subjected to ground surveys, which we will now push further into our ground truthing with the team being on site now, and then hopefully over drill ready targets in the coming months, which we will then share with you guys. All right, thank you very much, everybody.
Thanks, Jack. And just to explain, you are sitting in South Africa there, so there is a little bit of an internet delay when we roll those slides through. So thanks for your patience.
Okay, no problem, Tim. Thanks.
Now, there's just some questions here, quite a few questions. As per the DFS announcement, the completion of the DFS will now enable some discussions with financiers to accelerate the development. Can you give us an update on potentially where those discussions are at?
Sure, Tim. We've set ourselves the target to have a mix of financial instruments to fund this project. We've already had extensive discussions with financial advisors and also with some financial institutions that would fund this project. So I'm not in a position to announce anything yet, but we've had extensive discussions. What also is in our benefit is, as I mentioned in the beginning, that we've raised a bit of money a couple of weeks ago. That's now putting us into a position to start with our early works. And then that can delay our fundraising discussions until we know that we've got the right mix of funding together,
And so what are the potential opportunities, this question here, to increase the resource level from the kind of measured inferred from, 3.55 million?
Look, we've actually made an announcement this morning of where we were able to take our mining right area, as I showed on the previous slide. And we've added a big chunk to the south of that area. So we've got acceptance here in South Africa yesterday from our mines department to start with a prospecting right process. So we will be over time, over the next coming months, we will be adding more resources as we refine them going forward. It's like I mentioned, it's from a historical mining area. Where a portion of it was not JORC compliant, and we will now make them JORC 2012 compliant and then bring them back into our resource base. So there's big opportunity to add more resources and substantial resources back into our resource statement.
And what's the political environment over there at the moment in terms of the regulations, and also you've got the BOE ownership? Can you give some colour on that?
Yeah, let me just reframe that question. We've had some riots here a couple of months ago, which we all dealt with here in South Africa. It was one flare-up and then it got closed down very quickly by the security forces. And at the moment, everything here in South Africa is stable. And, with regards to security of tenement, we've always said here in South Africa that, any mining right, any prospecting right is safe. No one it hasn't been taken away from anybody. And the legal system here in South Africa still works very well. As I mentioned earlier, we've got a prominent mining lawyer on our board, Hume Scholes, who's advising us through all the steps. And, we've been through all the regulatory processes, so we've got a very secure mining right at this point.
Thanks, Jack. That's all we have time for. There's actually a few questions there that if you do have time, you could address by typing the answers. If not, I'll shoot them through to you over the weekend.
Yeah, please shoot them through and then I'll answer them. Thank you very much, Tim. Thanks for the opportunity.
Thank you. Next up, we have Zeotech, ASX code ZEO, market cap of 127 million, 1 year return of up 466%. The company is an industrial zeolite mineral technology company. We have with us the managing director, Peter Zardo. Peter, nice to see you again. Over to you.
Thanks for the intro, Tim, and ShareCafe for hosting today's webinar. And of course, all of you that have taken the time to learn a little more about the investment opportunity Zeotech presents. Next slide. Just a standard disclaimer. Look, Zeotech aims to be one of the world's lowest cost producers of molecular sieve zeolites. This will be achieved by using proprietary technology, which offers competitive advantages delivered by a low environmental footprint for the sustainable production of high-value zeolites. It's a diverse applications that zeolites present, which offers a material global market and the exciting R&D opportunities, which I'll run you through. Our focus is on environmental management solutions, sustainable food production, and potentially carbon markets. These opportunities are fast-tracked with the immediate access to exceptionally high-grade Toondoon kaolin feedstock, which will clearly accelerate the company's time to revenue. Next slide. Just a bit on the team. Zeo's got a highly experienced team with a skill set that's aligned to materials technology, IP commercialization, strategic execution, legal, and of course, in-house zeolite expertise, as our head of projects clearly has. The opportunity to commercialize all the facets of our proprietary technology is further enhanced by highly capable and respected research partners in the University of Queensland and Griffith University. Next slide. Zeotech is creating large market opportunities underpinned by its proprietary IP and the unique and diverse capabilities of synthetic zeolites. Each vertical represents a discrete revenue stream, and at its foundation is about a $2.5 billion mature global market specifically for type A zeolites. I'll delve deeper into each of these verticals and the potential income opportunities in the following slides. Next slide. Sustainable, proprietary, low-cost manufacturing is Zeotech's proposition. Its processes low environmental footprint, which drives the economic advantages over conventional methods, delivering a low OPEX and low CAPEX business, which delivers high margins across a range of high-value products. From an IP perspective, we're running our PCTs entering the national phase, and that's all moving well. And of course, everyone's waiting on an update on our pilot program, which has been going extremely well. With the factor of having several feeds running has added more front-end work, but obviously all for the right reasons. The team, which I'm sure are all in the lab working now, and thanks to them, at this moment, I'd like to actually take the opportunity to thank the team at UQ, School of Chemical Engineering, and also the continued support of UniQuest in helping Zeo deliver on its promise. I'm pleased to say it truly is a one-team effort. Next slide. So just a little bit of the back overview on zeolites. Synthetic zeolites are manufactured aluminosilicate materials with a sponge-like structure, a framework, as you can see in the black and white there. They're made up of tiny pores that make them useful as absorbents, catalysts, and ultrafine filters. It's the pore size, and I'm not sure if you can see this is just a piece of a zeolite molecule, but it's the pore size which determines the capability and defines the application of a synthetic zeolite. And these are measured in angstroms, which is about a tenth of a nanometer. And this is why they're commonly known as molecular sieves. For example, most elements have atoms with a radii of about 1 to 2 angstrom. Next slide, please. From a market perspective, Zeo's technology is targeting the largest segment of the global synthetic zeolite market, which is type A zeolites. They represent between 60 to 70% of the total market. And then we're further focusing on the high value component of the type A market, represented by 3A, 4A, and 5A molecular sieve grades. The Zeo's process advantage is that it produces very high grade type A or LTA zeolite in its first pass. And this can then be simply optimized by the way of ion exchange to produce high value molecular sieve grade products by using potassium for 3A, sodium for 4A, and calcium for 5A. What's exciting is molecular sieve absorbents have a wide range of applications in air separation, purification, drying oxygen production, hydrogen production. They're used in the insulating glass industry, carbon dioxide removal, desulfurization. It's just a vast windows of opportunity for the company. And even in the paint processing industry, then the bottom, they're used as a water scavenger. We are also looking to add type X zeolite to our product mix. There's been a lot of interest in that zeolite type for its use in air concentrator units during the COVID pandemic, as more and more use has been found to the need for pure grade oxygen production is needed. Next slide, please. Yep, Zeo's actually utilised lithium process residue or leach spodumene as a feedstock to successfully produce type A molecular sieve grade zeolites. The opportunity to develop a commercial cleantech solution for the lithium refinery industry is compelling, and the growing demand for electric vehicles, EV batteries, is driving the expansion of lithium hydroxide production globally, which will produce material volumes of lithium process residue. EV industry participants are increasingly seeking sustainability in their battery supply chain, and Zeotech believes its technology can offer a commercially viable option to manage lithium refinery tailings. And look, I believe that several options will be needed, but we're quite excited about what we're developing. And the METSIM modelling that we've undertaken using our lab scale data delivered very promising OPEX and CAPEX outputs using leach spodumene residue as a feed. And the aim now is, and the front end of the dual feed pilot is, that the METSIM modelling data will be refreshed from data that's created in our continuous circuit. And then this will be shared discreetly with the 2 lithium refiners that have provided samples to us to date. Next slide. Sustainable food production achieved by improved agronomic solutions has been an area of interest for Zeo. And last October, we kicked off a 9-month program with Griffith University, and the results achieved have been highly promising. Nutrient retention, application, and the managing of soil pH levels is a critical part of a farming program and represents a major annual expense. Zeo and Griffith University's concept was to scope the potential for zeolites to develop into a fertiliser delivery platform. And fair to say, the results we see on the screen there of nutrient retention, pesticide destruction, moisture retention, and decreased soil acidification are extremely promising. These outcomes have driven planning on expanded pilots for new product development targeting fertiliser delivery with adjunct carbon market opportunities and agricultural pollutants. I mean, soil carbon sequestration will be a key part of the puzzle in climate change mitigation, and it warrants a dedicated pilot to explore the opportunity that Zeotech may be able to offer here. Next slide. Again, the carbon capture program that UQ is underway at UQ at the moment is somewhat a mirror to the project that GU was running on an agronomic basis. That they're 9-month programs, and at present the objective here is to target understanding the dynamics and characterization of the zeolites we produce. And if you look across the right of the screen, all those articles are indicating that synthetic zeolites have been used for processes that can capture CO2. And what we're looking to do is to see if our we can find an opportunities that may improve the efficiencies and the processes using lower cost absorbents to deliver something that's commercial in the carbon capture space. And also potentially look at using zeolites as a catalyst to produce value-added chemicals. But that program is about 2/3 through. It'll be wrapping up towards the end of December. And look, we're hoping to get the similar results as we have with our agronomics program, and that'll be very exciting for the company. But there are some interesting things that we've discovered during the program, and we look forward to wrapping all those up into potentially expanded programs as we move forward. Next slide. Now the mycotoxin animal feed additives opportunity has brought together a collaboration with Bioproton, which is a leading and innovative animal feed manufacturer. The circumstance is that mycotoxins are created by a fungus that grows on a whole range of animal feeds, and climate change is increasing the propensity of this fungus to grow, and it's impacting the animal protein production globally, which as mycotoxins reduce weight gain, they can increase mortality. And this obviously is a critical component in global food production. And so we've handed over some of our zeolite samples to Bioproton that's using their know-how in undertaking some in vitro testing. And we're hoping to use those results to then move forward in developing mycotoxin binders for the global mycotoxin industry. It'll be a timely process, but one that's quite exciting. And the market itself for mycotoxin feed additives is in excess of $1 billion. So it's a tangible market, and again, one that warrants our exploring this work. And to have a partner like Bioproton to be working closely with us is very exciting. Next slide. We've got, and just recently we announced we'd secured the Toondoon approved mining lease. The Toondoon project is an approved mining lease that's the project's over 280 square kilometres. The high-grade ore has been used at UQ since about January in its testing. It's materially improved our OPEX for our process, but also, and quite exciting for the company in relation to getting closer to revenues for the company, is that the high grade of this DSO kaolin is really bringing up some strong interest from some samples that we've had in China, and we're looking forward to setting up an agency agreement there and move quickly to sort of maximise the opportunity of, one, using the kaolin on a DSO perspective, and two, obviously enabling a lower capex for our technology. Next slide. Now, just to wrap things up, and I can see I'm getting past my time. Look, just some near-term value drivers for the company. And when I say near-term, this is predominantly we're aiming to achieve these within the next quarter. We look at accelerating our DSO strategy. We're looking to set up some Asian markets representation for our kaolin sales into China and Japan. And the grade of the kaolin really warrants the company to be able to secure tangible buyer interest, I would suggest, in the near term. From the lithium refinery cleantech, we're looking to share the bench scale optimization results with the 2 lithium refineries before the end of the year. And again, continue progressing our pilot program and completing the circuit, and then moving to construction of the pilot towards the end of December. In the agronomic space, we've got GU that's preparing an expanded program underpinned by the positive results we've achieved on fertilizer delivery, agricultural pollutants, and carbon markets. We've got a lot going on, and our carbon capture program at UQ will be wrapping up at the end of the year, and we're looking forward to seeing if we can leverage those results into some exciting opportunities for the company. And with the mycotoxin opportunity, we have Bioproton that's undertaking the testing. We'll move to the next transition of that, and all going well, we'll look to formalising the collaboration with Bioproton. Next slide. Thank you.
Thank you. Thanks, Peter. Can we just go back a step with the actual zeolite? It's synthetic. Is it? Can you talk about its environmentally friendliness, if you like?
Yeah, I mean, synthetic zeolites are aluminosilicate, just the same, much the same as kaolin. They can be fed to animals as a mycotoxin absorbent, so they're non-toxic in any way. So they really are. I think the biggest issue that's faced synthetic zeolites is that there's a lot of applications, but they're very high cost. I mean, we're talking anything between $2,500 to $4,000 a ton, and that's potentially kept them out of reach of some applications which, you know, they would be. There's an appetite for them, and I think that's the area that's exciting for our company, because we do truly feel we could be one. You know, we're hoping to be the world's lowest cost producer, but the way things are looking, that'll enable us to potentially grow the market as we can target applications that synthetic zeolites may not have been able to be used before.
And does that kind of include the lithium process? Do you have to change the nature of the zeolite for, you know, lithium residue filtering or hydrogen separation or agriculture?
No, the end product doesn't, the feed won't determine what the end product is. The end product will always be, in our first pass, a pure LTA type A zeolite, almost 4A molecular sieve grade. Once either the lithium process residue feed or the kaolin feed comes into our circuit, it's not too far off. I mean, in the mineralogy of leached spodumene, one of the largest components is leached aluminosilicate, which is what we're trying to extract. So it's when we receive that, when we make that pure LTA, that we then decide, do we want to optimize that into 3A, which is we do by adding potassium? Do we want to make 4A, which is a little bit more sodium? Or do we want to make 5A, which needs calcium?
And just quickly, it sounds like the Griffith University opportunity is really exciting. Where do you see your advantage there?
Look, the carbon market is estimated to be worth about 40 billion to the land sector by 2050. And in the May budget, actually, there was about, I think, 200 million that was allocated to the National Soil Strategy. And in that, there's a component which will help farmers potentially completely reduce up to 90% the cost of soil carbon measurement. The benefits of efficient fertilizer delivery and decreasing soil acidification enables us to get an economic adoption factor to farmers to get the synthetic zeolite into the ground, and then leveraging Griffith University's strong agronomic capabilities and understanding. The scale of the opportunity really warrants us measuring the potential carbon sequestration opportunity that having that form of input into the soil, which is really there for the fertilizer, you know, to help the fertilizers, and the farmers understand that. But if we can get an adjunct carbon credit benefit from it, it is very exciting, and we're really looking forward to it. And I was only talking to Griffith University about it yesterday, and we're hoping to get the first updated proposal within the next few weeks.
Thanks, Peter. That's all we have time for, unfortunately. I mean, we could talk about this for hours, I think. So we'd love to follow up with you, but have a nice weekend, and we'll catch up soon.
Thanks a lot, Tim. Thanks, everyone. Cheers.
Next up, we have Apollo Consolidated, ASX code AOP, market cap of around 112 million, 1 year return of 15%, up 15%. The company is a gold exploration company based in Perth, with its focus being in the eastern goldfield of Western Australia. We welcome back Nick Castleton, who is the Managing Director. Nick, thanks for your time.
Thank you, Tim, and thank you everyone for tuning in to have a listen to this story. Back to gold. This is this truly was a hidden gem. It sits undercover, which has transported profile 150 kilometres to the east of Kalgoorlie. We didn't know it was there. No one knew it was there until sort of 2017. We got first diamond core into it, and I really understood the geometry and the potential of the mineralisation that's sitting undercover out here. So really glad to tell the story. Next slide, please. Skip through, please. So the reason we're excited about this discovery is they don't come along very often. Here, the Kalgoorlie district is pretty mature. There's been a lot of exploration over the last 30 years with drilling rigs and modern day geochemistry. This thing just was hidden out there. We've taken it from a point of discovery to current resource base of 1.1 million ounces of gold, and we only report what sits inside a constrained shell generated by the engineers. So we think they're quite high confidence ounces. That's carried through a 74% of them being in indicated category. So really important discovery. We know we can make it bigger. We had a previous life in West Africa that we've been divesting over the journey, and it's left us in a really good cash position. We burn about $1.5 million a quarter on exploration and building the project, but you can see we've got plenty of cash to do that work. And once we had the 1 million ounces in hand, it was quite clear that this thing had commercial possibilities. So we've pushed on and doing some quite detailed study work, and I'll talk to that in a little bit coming up. But regardless of all of the value that can be added through the study work and the exploration rig, we know we're in pretty good shape in terms of relative valuations per ounce for in-pit constrained ounces in this part of the world. And the reason we're good value is this part of the world is the very best place to go and find a new discovery. We're a short drive from Kalgoorlie and everything that's needed. Next slide, please. I won't spend time on this. We're in good financial shape. Obviously, the capital structure has been preserved quite well by divestments. So actually, we just put out our annual report yesterday. We've had 4 consecutive years of accounting profits, which is quite unusual for a company that's building a resource base. But you can see that in the share price, we've been slowly adding value to our shareholders. Those are predominantly guys that have been with us since we started exploring in West Africa and have stayed with us for the Rebecca discovery. You can see what's happened to our share price since then. Next slide, please. I'm an exploration geologist, been doing this for a long time, and really well supported by Tony James, who knows everyone in Kalgoorlie. He's a mining engineer. He knows how to wrap financial parameters around what we've found. It's really important to us. Roger Steinerprice is really well known in Perth corporate and legal circles. Next slide, please. Now, this is where I start to come in. Obviously, so it's a great place to be. It's on a haul road, well, not a haul road, but a mine support road that goes out to the east of Kalgoorlie and goes all the way through to Tropicana. So it's a nice all-weather road. It's about a 2-hour drive. We're at the southern end of a belt of rocks called the Laverton Tectonic Zone. There's more than 30 million ounces of gold to the north end of us around Laverton. We knew it was a good place to explore. And we knew that exploration was underdone, I suppose, when we took on the project, and that's come to pass with the discoveries we've made. Now, in that figure on the right-hand side, that's an aeromagnetic image. We knew about the Duke and Duchess mineralisation. It was already there in the database we inherited, but most importantly, we knew that going north of Duchess, there was more and more transported cover and less sensible exploration work, and that was the opportunity. And sure enough, we've discovered the Rebecca deposit itself up in the northeast part of the tenement group. It's bigger, it's better, it's higher grade, it's got great geometries. It's got 840,000 ounces in itself of gold inside this optimized shell. We know that it's a plus million ounce system in its own right. Finding that means we can find more, and since then we've started to find some really nice gold at a place called Cleo out to the west, and you can see some plenty of exploration targets ahead of us to go drilling for more. So it's delivered what we thought it could do when we first picked up the project. Next slide, please. Now I'm going to unpick the Rebecca deposit a little bit because this is where the real value lies. A couple of figures here. The colourful one on the bottom left, that's a slice along the length of the block model. So all the coloured shapes there are mineralised blocks that the resource geologist has given us. You can see that there's a black line that encompasses that. That's the base of the pit the engineers say is commercially viable. And we know there's 840,000 ounces inside that pit. I talked to what happens below the pit, but inside the pit shell itself, you can see on the right-hand side, the endowment inside that pit shell sits comfortably between 2,000 and 4,000 ounces per vertical metre once you get down through the transported profile. And that is maintained all the way down to the point where there's just no more drill information. So what that says is it's what we know about in the top 300 metres will very likely reproduce again in the next 300 metres. So it's a very serious gold system. Next slide, please. A couple of slices. We put out a lot of cross sections, but these are a really good way to look at the deposit and how they perform in cross section view. You can see the grey shapes on all our cross sections are this hypothetical pit shell. You can see there's quite nice geometries involved. You don't have to squint too hard to see that the strip ratios might be relatively tame. West dipping for the most part, except in the southern part of the pit, which is a slice on the right-hand side. This is where things steepen up and us geologists get excited. There's a lot more gold in these steep zones, typically 10 to 30 metres true width and typically in the 3 to 5 grams per tonne. There's not many pits around operating in WA where you can get that material in a pit floor. And this is what drives this project forward. And I think it's actually quite robust under different gold price environments because of this high-grade system. Next slide, please. Again, with the exploration hat on, this is where we applied the drill rigs. The top right-hand image there is another slice along the length of the system. And what you can see, I won't go into them individually, but there's a lot of intercepts along the whole 1.8 kilometres below what we know that have got all grade hits. And the real prize is to keep populating that density of information. And somewhere in there, there's going to be more of the intercepts like there's the stick of core there. That's the part of the Jennifer structure itself. Intercepts similar along the lines of 5 grams per tonne over 20, 30, 40 metres downhole widths. They're exceptional intercepts. That means that one day it's very easy to imagine a point where you've, during or towards the end of the open pit mining, you move to an underground set. Now, what we've been doing also in this year, and it's been important, is we've been adding ounces inside this hypothetical pit shell that didn't previously exist. So the colourful areas on the bottom left image were unclassified mineralisation, wasn't drilled to a high enough density. What we've found so far this year, luckily, is that A, there's better grade than we expected, and B, there's more gold than we expected. And this, in effect, this is a free kick for extra ounces inside a pit that was hypothetically already dug. So that's going to be great for economics. Next slide, please. Right, now this is just a spin of the leapfrog model. So this is all drilling. It gives you an idea of the shapes of what we're looking at and talking to. You see it's west dipping up in the north end as we spin around, and the central part of the pit gets quite complicated where in effect the lodes just wrap around each other and you get 3 looks at the same surface in the middle part of the pit. Lots of colour there. You can see there's a colour on the drill strings that haven't got any blocks. There are new drilling. So we know that we can expand gold mineralisation into those areas. So this system is very much live and well. Next slide, please. Right, now that's Rebecca, 4 kilometres away to the south. Very easy trucking distance is Duchess and Duke. These things are very straightforward, really. There's slabs of mineralisation that either dip to the west or vertical. Individually, they get up to 20 metres true width, not high grade, but really nice geometries. You can see again that there's potentially a reasonably low strip ratio in these places. Live to strike in places, definitely live to depth. You can see the block model just going off end down bottom right. Next slide, please. Duke is a very similar thing. So this time it's just sitting vertically. It's a really consistent slab of 1 to 1.5 gram grade gold. I wish it was a bit longer, but it is what it is. But certainly at some point you can picture this sort of material driving 4 kilometres up the road and being tipped into a plant that might be up closer to Rebecca. Next slide. Now with the ounces we have in hand and the finances we've got available, We've taken the opportunity to get some of the best brains in the business involved in building the packs of technical information we need to understand how this thing might perform financially into the future. And so that's been collected since we released a resource update. So we've had metallurgical drilling, we've had hydrological drilling, flora and fauna surveys, et cetera, So that work is ongoing. It's building individual packs of information that our engineers will put together and understand how best to model up a financial mine life around this deposit. We know for a fact it's going to be led initially by the Rebecca deposit up in the northeast. Next slide, please. This is in my ballpark. The exploration rigs, we've been going all year with the rigs. We'll keep going. There's plenty to do. This is just an example of a slice through the 3 deposits that we know of. And you can see that we've got 6 kilometres to play with just in this section. We have mineralisation in our shells. We have mineralisation that's starting to emerge elsewhere in the paddock. And it's particularly the undercover country from Duchess to Rebecca that holds the real upside. And that's a matter of just systematically pushing through and doing the technical work and drilling the holes. So I can see that work going for some time, and we never know when the next ounce position might turn up with that drill rig. Next slide, please. So just wrapping it all up, not many 1.1 million ounce deposits sit out there in the gold fields that are, I suppose, unencumbered. We don't have a big brother. It's a new discovery. We're not having to dig and truck from multiple old pits. It's a really excellent start. We've got plenty of cash, and we've got plenty of work to do on the study side and with the drill rigs. We think we're good value at the minute, and we know that we can add value through these works as we go forward. I think that's all I have to say. I look forward to any questions. Thank you.
Thanks, Nick. It really is a great gold story. And so with that cash position, is it hard to get exploration rigs, and can you really crank things up? I mean, you said you're burning $1.25 million, but with $36 million in cash, can you really put your foot down out there?
Yeah, I get asked this question a lot. We have 1 to 2 rigs going at any time with a good team out there, and the problem, I think, it's for us is not so much the ability to drill. It's more the ability to understand what the drill holes are telling us in terms of the delays in the assay turnaround, and the nature of this deposit, because the lodes, although they're quite wide, they can bend and twist through space. We are best served to spend that money when we know what sort of assays we have in hand, and we don't know that until we've got the results back. So we're a little bit limited by that, but certainly we're looking to add more machines and more geologists to the work, because we've got plenty of it to go on with.
And a question here, so at the Rebecca deposits, do these systems typically continue at depth, and would you expect grades to sustain underground mining beyond an open pit?
The first part of the question is most definitely they're open to depth. We haven't seen any reason why they deplete going downwards. And as showed in that ounce per vertical metre slide, it pretty much stops dead on the base of knowledge. Can we get commercial grades down there? Well, I think this structure that we speak to called Jennifer, I haven't got the actual ounce position for that surface by itself. I'd imagine it's about 250,000 ounces, and it's probably in the high 3s or low 4s. That at 10, 15, 20 metres true width is most definitely an underground position. And if we can string a bunch of those together, then this could be a very long-lived operation underground.
And there's a question here. You appear to be mining next to a lake or a floodplain. Is there any extra environmental issues there at the moment?
No, we don't impact the lake boundary at all. And the intention is to just not encroach on it. We'll be doing everything that we need in terms of infrastructure out to the west. We've got plenty of open space out to the west side of the mine itself. We especially don't own any of the lake, so it's not really something we encroach on.
Okay, and just finally, can you give us an idea of the timeline moving forward? What
The
investors?
study work's in progress, and some of these are long. Again, some of the delays out of labs and things. They're long lead time items, but we should have the lion's share of that work in hand and reported by the end of the first quarter next year. So yeah, metallurgy and the seasonal environmental survey work. That's the two items that drag on a bit. But by the end of next quarter, we should have all those information packs in hand, and we start to cobble them together and understand how this works in terms of a feasibility study.
Great, Nick. A really fantastic story. Congratulations, and we'd love to follow up. And I'm certainly going to keep an eye on it. So thanks for your time.
Great. Thank you, Tim. Thank you, everyone. Cheers.
That's all we have time for, everyone. Thank you. I think it's a couple of great stories there. Have a nice weekend, and we'll see you next week.